Hi, Dan. Great to be back. I mean, the number that I find most interesting from that Chinese data release this morning was 4% year-on-year nominal GDP growth. I mean, we have almost 4% nominal GDP growth in the Eurozone, closer to 6% in the US, obviously much higher in some other emerging markets like India or Indonesia. And that really says why China is needing to stimulate its economy. So far on the fiscal side, I think it's kind of what we've heard has been more plugging holes in balance sheets. So local governments have needed some support, given that they've been relied so much on to support growth in prior years, and that had led to debts building up. Same with the banks needing their capital shored up. Rather than, we're protecting the balance sheets rather than really leading to big growth impetus. So for now, I'm not sure I've seen enough to get really excited about a growth upswing in China, but there are expectations that more will come.
Okay, so there's more stimulus to come, at least according to policymakers. The PBOC also now talking about not ruling out additional rate cuts to prop up the economy. We've also seen measures announced this week in the property sector, for example. That's been one of the key trouble spots. What do you think it means for the equity trade moving forward in particular? It sounds as if you're not so confident about making a play into China right now. Maybe just expand on that for us.
I think Chinese equities have a place in a portfolio, and given that they're still pretty cheap and that sentiment could move considerably higher, I certainly wouldn't want to be underweight China. However, given that you'd had really strong growth in China for the past decade and it didn't necessarily translate into strong equity market returns, given that we've seen monetary easing before that hasn't necessarily structurally lifted the market, I'd still be a little bit reluctant to call this a structural bull market in Chinese equities.
Okay, so let's talk about what just happened in Europe as well. The ECB cutting rates as inflation falls below target. What does that mean for your European risk asset exposure right now?
So the ECB cut 25 basis points. We've seen 75 basis point cuts so far this cycle. And they remain data dependent, which basically just means as long as inflation and growth don't suddenly surge, which seems unlikely, they'll probably keep gradually easing, maybe not as much as markets have priced, but that easing is going to continue. I actually think that inflation is still a little bit sticky in Europe. So the main thing that this means is with growth coming lower, inflation still above target, policy rates coming down, you're going to see really low real rates in Europe at some point next year. And so I think that's going to continue to put downward pressure on the euro. European equities overall are an interesting question. Given that growth is still a bit subdued, I think you want to be a bit selective within European equities. So we like using European equities to play some kind of longer term or global themes. So for instance, decarbonisation, electrification of the economy. There's some great European equities that you can use to play that theme.